Hello, everyone. Good afternoon. Thank you for being here with us, and thank you for listening to me. My name is Marcio, and I'll be talking to you for the next 25 minutes about the PIMCO Balanced Income and Growth. We call it PBIG, and this is not the PIMCO Income Fund. So a lot of you know the PIMCO Income Fund, our fixed income, flagship fixed income fund. This is not the PIMCO Income Fund. This is PBIG. And I'll explain to you why it's different and maybe a good idea for you to consider investing. So PBIG is a 60-40 fund. So we invest 60% in global equities and 40% in high quality fixed income. And high quality fixed income is a very important part of the fund, and I'll talk to you a little bit more about that as well. This fund has a distribution, a dividend paying share class. We're paying right now 7% per annum, and that's being paid monthly. And last year, the fund was up 17% in Singapore dollars. So very, very strong performance, very attractive dividend payout, and a strategy that I'll talk to you a little bit more about it as well. So for those of you who don't know PIMCO, PIMCO is a US asset management firm. We manage $2.2 trillion in assets. And as you can see here in this map, we have presence and offices throughout the world. A lot of you might know PIMCO as fixed income only shop. You know, PIMCO does a lot of bonds. We do fixed income. Bonds are part of our DNA, but we also have been doing equities since 1986. So we started equities in 1986. We've developed and we grew our equity platform over the years. And today we manage $48 billion in equities. And I'll also walk you through how we do equities and how our approach is different than our competitors out there. So before diving deep into the fund, I want to talk to you today about a concept of the 60-40, right? 60-40 has been a concept that has been around for a long time. And I would like to spend a little bit of time telling you about why we think the 60-40 approach is very attractive. So what you see here is a graph since 1990, okay, 1990. And if you had invested in a 60-40 fund in 1990, gone to the beach, gone to Japan, gone to Taiwan, and came back, you would have had a 7.24% return per annum. And the most important thing, only 2 periods of negative performance if you look in a 3-year window. So the 60-40 concept is a very interesting place to start when you're thinking about building a portfolio, because it has given you attractive returns with a lot of resiliency. Another way to look at the 60-40 portfolio is comparing it to equities. A lot of investors invest in equities, and they like investing in equities, and there's a thrill to buying and selling stocks. But from a pure investment perspective, what we're showing here is the red dot is global stocks, and the green dot is the 60-40 portfolio. You can see they're in the same height in the graph, meaning that a 60-40 portfolio in equities have given you similar returns since 1990. But as you can see, the green dot is in the middle of the page, and the red dot is to your right, meaning that a 60-40 portfolio gives you equity-like returns, but with 37% less volatility. So you can sleep better at night, and you're going to see less drawdowns. So that's why we like the 60-40. It will give you equity-like returns with better risk, sleep better at night, less volatility. So now the question is, which 60-40 portfolio should I choose? And let me walk you through the PIMCO Balanced Income and Growth PBIG. So what we're doing here is we're investing 60% in a global diversified portfolio. So we're not doing just US, we're doing other developed countries, we're doing a little bit of emerging markets, but we're really looking to the globe to find opportunities. And we're doing 40% in high quality fixed income. And this is very important. A lot of our competitors, they do similar products, but their fixed income component are not high quality. They're investing more in higher yielding, a little bit riskier bonds. And what we're doing here at PBIG, we're doing high quality bonds. And the reason for that is high quality bonds can protect in the downside. In moments of time that equities are going down, that high quality bond will protect you in the downside, and I'll show you a little bit later. And we're also doing some tactical adjustments to the fund. So we're being disciplined, we're keeping the 60-40 ratio so you can enjoy those benefits of the 60-40 portfolio that I mentioned, but we're also managing risk and exposure on your behalf. So if we think that the world might be more volatile, if we're seeing more risks, we can tone down the risk of the portfolio. But if we're also seeing more opportunities, we can add exposure. We will be rebalancing the 60-40 as time goes by, so you don't have to worry about doing that. And the equity component, we rebalance every 2 weeks. So this is a strategy you can put money, you don't have to worry about coming in, coming out, timing the markets. PIMCO will be doing that for you. So now let me walk you through the different sleeves of the fund. So the first one is the fixed income sleeve. As you can see here, we're focusing on a very well-diversified, high-quality portfolio. The easy way to identify that is the blues and the greens are high-quality bonds. So the blues are government-related agency bonds, and the greens are investment-grade rated bonds. So we're really focused on high quality. The average quality of this portfolio is AA minus, so very high quality. And this portfolio is giving you a yield of around 6%. Now let's talk about the equity part. A lot of you might be thinking, equity seems expensive right now. Is this a good time to invest in equities? And that comment is true when you think about US equities. I know this slide is busy, so let me walk you through a few things. So when you look at your right, those bars, you're seeing US stocks, other developed country stocks, and emerging market stocks. The height of the blue is the PE ratio, and the green dot is where we are right now. So as you can see, US stocks, the green dot is really close to the ceiling of that bar, meaning that, yeah, US stocks, they are looking more expensive. And the reason for that is, you look on your left, is a lot of the tech and Magnificent Seven stocks. When you look at the other two bars, you can see the green dot is somewhere in the middle, meaning that other developed countries and emerging market stocks, they don't look as expensive. So when you're looking even to buy stocks, you have to have an approach to avoid those expensive stocks and really find opportunities throughout the global opportunity set. So let me explain to you how we at PIMCO were doing that on your behalf. So we look at 4 screens when we look at equities. The first screen is quality, which is the financial health of the company. Is this company profitable? Are they making money? The second one is value. Value is valuation. Is it expensive or is it cheap? The third one is momentum. Is the stock pricing going up or the stock pricing going down? Typically, you don't want to buy stocks when they're on their way down. Typically, you want to try to buy stocks when they're starting to go up. And the final one is growth. Is this company growing? Do they have prospect to growth? So these 4 themes are nothing new. They have been around for a long time. But what we do different is we have a systematic approach here. So we've designed a process which we are starting with 2,600 stocks, as you can see on the top of the slide. And then we screen those 2,600 stocks to these 4 themes: quality, momentum, value, and growth. And we give each stock a score. And you can see that on your right. And then we rank all the 2,600 stocks based on that score. We buy the top score, we avoid the bottom stocks. So in this example, stock A had very good scores for value, quality, momentum, growth, a total score of 78, we bought that stock. Stock B had a very low value stock, meaning expensive, and it was okay for the other themes, we did not buy that stock. So we do this exercise every 2 weeks, and we rebalance the portfolio every 2 weeks, always looking for the stocks that do well on the 4 different themes together. And then we end up with a portfolio of around 300 to 500 stocks. What is the advantage of having this systematic approach versus what we call the fundamental approach, which other competitors use? What we like about the systematic approach is it's driven by a computer, a process. So we're putting these stocks on a model, and the model is coming out with these scores and telling us these are the stocks you should buy. Of course, there's a human being that looks at it, make sure that everything makes sense, and then we buy the stocks. It's unemotional. We don't have a person there that might be tied to a stock, might be biased towards stock, that might get nervous or might get anxious that prices are going up or down. And we believe that this systematic approach is better than the fundamental approach. And our performance has been very, very strong using this approach, and we really like it. Today, this is the PBIG portfolio, so I know this slide is very busy, but I would like to highlight a few things. The first one is our PE ratio of the fund right now is at 16. This is very important. If you look at the PE ratio of the S&P 500 or MSCI, it's higher, is 24, 26. What does that mean? A PE ratio that is high means that stocks are expensive. A PE ratio that is low means that stocks are cheap. We have a PE ratio that is lower than the overall index, meaning that we're not buying the expensive stocks. We're not buying the expensive stocks, and that's where we're really adding value for you. As I mentioned before, the credit quality of the fixed income portfolio today is AA-, and we're holding 990 different bonds. So very, very well diversified. I was in the booth earlier, and someone approached us and said, "What are your top holdings?" And I said, "We don't think about concentration of top holdings. The way we think about it is really being diversified, and that has what worked for us. And that's why today in the fixed income side, we have 990 stocks. And in the equity side, as you can see, we do have exposure to U.S. equities. U.S. equities is the biggest market out there, so we do have exposure. But as I mentioned, we're not buying the expensive stock. We're looking for stocks that meet the 4 themes, and we are also well diversified in other countries. What's the result? The result, this is the performance of the fund. The fund was up 17% last year in Singapore dollars, so we had a really, really good start last year. The year before, 2024, the fund was up more or less 10% in Singapore dollars. So we've had a really, really good track record with the fund. As you can see, that line that has the green highlighted, that's the Morningstar category ranking. We've been in the first quartile. We've actually been in the first decile in all the different periods of time. So this is a best-in-class fund compared to its peers. And when you look at the attribution in terms of fixed income equities in the tactical portfolio, you can see both the equity and the fixed income portfolio has been adding to the strategy. So as I mentioned, very good performance, very disciplined approach, and that's what makes this fund very special. Let me tell you a story about this strategy and why we think being disciplined is important for you. Back in April, when Trump announced the tariffs, what he called Liberation Day, what happened was stocks went down and bonds did actually a little bit better. And I asked all of our clients, how many of you in that day sold bond and bought equities? And not a lot of people did that. And our portfolio manager, he needs to be disciplined. He needs to be in the 60-40 ratio that you trusted him with. So that day, he sold fixed income and he bought equities because of that disciplined approach. What happened next? Equities did well. And that's why you're hiring us to do that for you. Because we are going to be disciplined and we're going to keep that ratio for you. We're going to rebalance for you. And that's why we think also on the systematic side that works very well. You might be asking, is this a good time to buy PBIG? I always say that you shouldn't try to time the market, especially for a fund like this. It's an evergreen fund. Stocks and bonds should always be part of your portfolio. But the good news is it is a good time to buy PBIG. And let me walk you why. When you think about growth in the world, growth has been very resilient. Despite of everything that happened last year, all the announcements Trump had, geopolitical risks, growth has been pretty stable and positive in most countries in the world. If you think about this year, the tax cut extension from Trump will take into place in the first half of this year. The households in the US will each get more or less $1,000 that they will spend. So you should expect the first half of this year to have a pretty resilient and a growth economy in the US. Inflation has come down over time. Now inflation is really range bound and closer to the Fed's target. So inflation should not be a concern. And most of the central banks will continue to cut rates this year. We think the Fed in the US will probably cut 2 times at the later part of this year. So this environment where you have positive growth, inflation range bound, and the central bank cutting rates, it's a great environment for both equities and fixed income. And when you think about what I said in the beginning of my presentation, that a 60-40 can give you equity-like returns with less volatility, it's a really good time to think about adding PBIG to your portfolio. Here we highlight a few of those. You're having global diversification, the high quality exposure, the beta tailwind, meaning both equity and fixed income should do well, the alpha opportunities where we are adding value on top of just the 60-40 portfolio. You're capturing the equity upside when equities go up, but you also have the fixed income to buffer the downside when markets are choppy. So to summarize my presentation today, PBIG, the PIMCO Balanced Income Growth, is our 60-40 portfolio, 60% global diversified equities using a systematic approach, a disciplined approach, and 40% high quality fixed income that will be there and buffer your portfolio when there's volatility in the market. We have a share class that pays 7% per annum. That distribution is done monthly. And as I mentioned before, last year the fund was up 17% in Singapore dollar hedge share class, and the year before the fund was up 10% in Singapore dollar hedge share class. We have our PIMCO booth right over there. So if you have any questions after this, please stop by and we can answer any questions you might have. For all of those who are PIMCO income investors, I thank you very much for your trust, for your support, and we appreciate your partnership. Thank you so much for listening to me today.